us now work through a specific example with numbers based on the principles that I've told you about in another video. So in this example, if you were a 35-year-old and wanted to pay for a $10,000 5-year term life policy upfront, how much would you have to pay? In other words, what's the price of this policy for you to be covered with the face value of $10,000 for the next 5 years? That's basically the problem. What is the price? What is the value of that policy today? And we're assuming, 35-year-old, we're not specifying the gender. It really doesn't matter. We're saying this is the information. This is the appropriate mortality table. If you want to assume it's a male, that's fine. Doesn't matter. But so here's the example. So here's the mortality table that we're going to use for this calculation. Now, keep in mind that this is a term life policy. So it means that the beneficiary of this person gets paid only if this person were to die sometime in the next 5 years. Otherwise, there's going to be no payout. You're just going to pay the premium, have a coverage, but that's about it. So this is more like renting. In the examples we have seen before, you pay money in, and you have the benefit of being covered with the up to that face value of the policy if something were to happen to you, but that's about it. And for purpose of discounting, we assume a 4% interest rate. So the way we're going to work this solve this problem is that we're going to first isolate, as I've taught you in other videos, what are the information that we've given. So this is like a story problem, right? To use a term that I've used before. So we are given that the policyholder's current age is 35. The face value of the policy is 10,000. These amounts don't matter. You can scale it up to $1 million. Everything, none of the basic discussion will change. Just the sums involved will be different. The N, in other words, it's a 5-year policy, so N equals 5. And for purposes of time value and discounting, we're going to use a 4% interest rate, annual interest rate. So having said all that, what we need to do is, as I've told you in another video, the first step, we're going to have expected claims at each of the subsequent ages. So at 36, at 37, 38, 39, and 40. The reason being is that you cannot predict what's going to happen, right? So the insurance company has to calculate this on an annual basis, on a what-if basis. What if this person were to die between 35 and 36? What would be the expected claims? What if the person then died between 36 and 37? What would be those expected claims? And so on till 39, the period between 39 and 40. So those be 5 intervals where the insurance company has to do the what if on an annual basis and figure that out. And that's exactly what we do in this case. We simply calculate the expected claims at 36, 37, 38, 39, and 40 by multiplying the face value, which is expected claims is nothing but the likelihood of something happening, multiplied by the dollar amount involved, right? So it's expected. It's a future expectation. So remember, these numbers are the column 4 numbers that we saw on the mortality table, corresponding to a person dying between 35 and 36, 36 and 37, 37 and 38, 38 and 39, and then 39 and 40. So if you multiply each of these by the face value, you have these 5 expected dollar amounts, which are actually given here, the 21.1, 22.4, 24, 25.8, and 27.9. Now, what we need to do in step 2 is to simply discount these sums that occur at times 36, 37, 38, 39, and 40, each of them back to the starting point, which in this case is age 35. So clearly this 21.1, which is the product of this first sum here, will have to be discounted 1 period. The second 22.4 will have to be discounted back 2 periods from 37 to 35. The 24 has to be discounted 3 periods from 38 to 35, 39 to 35, and finally 40 to 35. That's a 5-period discounting back. So if you were to do all that, which is what's going on here, which should be fairly simple to you now, you can see the discounted values at time 35 are all given here, these 5. Once we sum them up, we get 107.32. That is the lump sum payment that is due at 35 for this policy holder to be covered for a $10,000 face value term life policy for the next 5 years. Now, again, I want to make the point that assuming this is a fairly modest amount, but understand the face value is just $10,000. So if you were to scale this up to, let's say, $1 million face value policy, right, which is what typically people do when they buy life insurance policies for larger dollar amounts. So then all that would change is a scale issue. So $107.32 for $1 million policy would become simply $10,732, right? So you're going to multiply everything by 100 to go up from 10,000 to a million. And likewise, the policy premium will also change. The lump sum premium that'll be due for that case, where the face value is $1 million rather than $10,000, would simply be this $107.32 multiplied by 100, scale that up by 100 as well, and that would be $10,732. Now can be a problem because a lot of people may not have almost $11,000 ready to pop into a life insurance policy at a moment's notice. And so what do you do in that case? And that will be the subject of our next numerical example.